Hello and welcome. I'm Joyce Blonskij and your host of Brilliance by Blonskij. I'm very excited to share with you a series of 4 interviews I did with Joseph Meyer. These are at the center of all of our conversations today. Our interviews go from finding good paying jobs and how employers can find the best talent, or whether or not now is the right time to get into a new home or just sit tight. We're going to talk about the rising costs of caring for your elderly parents, commercial real estate, and a bunch of other things regarding real estate. We're also going to talk about how much it costs to fill up your gas tank and how much more or less it could down the road. We're going to look at how cloud computing and cloud companies can actually reduce your bill when it comes to the gas pump. And lastly, we're going to take a look at the stock market, and Joseph will weigh in on his outlook on where you should be invested right now. Let me take just a moment to read to you a disclosure and a quick little bio for Joseph Meyer, and we'll get started. Securities offered through Cambridge Investment Research, Inc., a broker-dealer member, FINRA SIPC. Investment advisor representative, Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and Blonskij Financial Services are not affiliated. In today's volatile investment community, we all need to be confident of obtaining the most accurate information possible in order to make some very critical financial decisions. We find this valuable information by locating the most experienced individuals in their particular field of expertise. In the field of financial services, there are few who can compare with the level of professional experience and expertise of Joseph Meyer. For nearly 4 decades, he's been personally and professionally involved with the U.S. financial industry. He has literally helped thousands of people find their way through the maze of questions that can arise in an ever-changing financial environment. Meyer has seen good markets turn bad and then turn back up towards prosperity again. Joseph Meyer has the answers that only experienced and common sense can provide. Mr. Meyer has entered the brokerage industry back in the early 1970s as a broker-dealer trainee with the firm of Edwards and Hanley, a member of the New York Stock Exchange. He was employed by a number of top New York Stock Exchange firms as a registered representative, including Edwards and Hanley, Merrill Lynch, Shearson, Hayden Stone, Inc., and Payne Weber, Jackson and Curtis. Meyer has also been a professional insurance agent and a licensed in health, life, disability, annuity coverage with Bankers Life and Casualty Company. He became a self-employed stock market strategist and professional equity trader and went on to become a registered investment advisor. In 1989, Meyer developed his management consulting firm, Myers & Associates, to help with the disposition of non-performing structured assets. Meyer is an industry arbitrator with the National Association of Security Dealers and the New York Stock Exchange. I am so pleased to be able to bring Mr. Meyer to our audience today as we discuss a number of wonderful topics in a series of 4 interviews, from jobs to homes to gas and, of course, the stock market. So please join me in welcoming Mr. Meyer. You're listening to part 4, which is the last of our 4-part series, and this is going to be one of my favorite topics, the stock market. Joseph Meyer will be weighing in on his outlook on where you should be invested, where the market is going, sectors of the market, some really wonderful insights. So if you have investments or should think about starting investments and looking at diversifying your assets throughout global and domestic companies and want to own some great companies, this series of our 4-part series is one you're really, really going to love. So here we go. Let's get started. Another area that you speak of is the stock market. Yes. You talk about having come back from the lows of 2008, and I didn't know we would still stay above 13,000 after the last few trading days, but we still are above, at least during the course of this interview, we're still above the 13,000 level on the Dow. There are so many forecasts out there, and they really do hit both sides of the investment opinion. There are folks like Charles Nenner who believe that the market is literally going to just drop like a rock, and you might as well all just get out now and save yourself the aggravation. And then you have others that say, 13,000 is on its way to 20,000. So we really have both ends of the spectrum. And of course, you kind of correlate that back to gold and silver prices. So maybe you could give us some of your thoughts on where you fit into this debate.
Well, first of all, I don't believe we're in a new bull market. What I do believe is going on is we have a cyclical bull within the confines of a long-term secular bear market. And I believe that secular bear market started in 2000, even though we did make a higher high than we did in 2007. But I think when we speak more specifically about the markets, and I think, again, we get back to, where is there opportunity, where is there good value, I think the broader market on balance, when you take a hard look at the statistics, and I think you go back and you certainly compare the areas in which the Dow Jones was trading in January of 2000 versus where we were most recently in March of 2012, the Dow Jones on average was up less than 1% in that 4-year period of time. But I think when you talk about the sectors of certainly gold and more importantly silver, I think you can see there we had silver up 96% in 4 years and silver up roughly 116% in 4 years. So even though it was a long-term secular bear market, I think cyclically within the confines of that market there were sectors that certainly outperformed the Dow. So I think it comes down to allocation of capital. I think it comes down to being in the right sectors of the market, and I think more importantly and lastly, being in the right companies within those sectors, Joyce.
Yeah.
But I think when you talk about the possibility, could the March 2009 lows be the final bear market bottom? I doubt that very much. I think when you take a look at where we had traded in March 2009, certainly we traded 670 in the S&P and 6470 in the Dow. But I think when you take a look at history, and I think history once again comes into play, and I don't think it's something we should ignore. I think people have to take a look, and I think you touched on the word, they're delusional, they're looking at what's happening in the equity markets, and they want to believe on balance the worst is behind us. They want to believe this economy is recovering, even though I think you look at the unemployment statistics and they're flat on balance. You look at housing, it's still continuing to sink. I think you look at the foreclosures and you look at the bankruptcy filings, they're still accelerating. So even though this market is 13,000, I think it's a smokescreen, and I think it's delusional insofar as the overall weakness we still have in the economy.
Yes. Well, let's just hope that people are smart with their investments. They don't have all their eggs in one basket. They're not heavy in one area, that they've got a plan B, and that they are nimble enough, and they're also smart enough to know that, honestly, to go this alone, I've said this to my husband so many times, I don't know what I'd do without me.
Don't do it.
Seriously, I don't know what people do who don't have somebody that actually understands all this. I feel bad for them.
Well, I've said many times, these are unprecedented times. These are uncharted waters. I mean, we are facing now a crisis and a difficulty globally, with us continuing to do the things that we've been doing over a number of years. We're coming to the end of the line. There's going to be some big changes, and there's going to be a lot of pain because of it. You've got to be prepared for the inevitable, and you've got people sitting back. They want to believe the worst is behind us. I've gone on record many, many times, and I've said, I don't believe the worst is behind us. I believe it's still in front of us. That doesn't mean you have to be devastated by it. I think there's opportunity. I think there are areas that will continue to do well where you can make money, but I think it's going to come down to asset allocation, the quality of the assets, the diversification of the assets, the selectivity of the assets, and it's going to come down to, are you with the strongest stocks for the right reasons? Are you with the leadership? And I love where you touched upon the point, don't go in and buy the cheapest stock in the group. Buy the leadership, buy the quality, buy the company that's going to continue to grow, continue to attract market share. If you're going to be in a sector and you're in the sector for the right reasons, why not own the leadership?
Yeah.
Well, people cry on balance because natural gas is down $2 a million cubic feet, and they say, well, it's been a very poor performer. But if you take a look at the high-quality natural gas sector and you look at the leadership, you can get between 4.5% and 5%.
Oh, I do know that. So, Joseph, you had mentioned that having a plan, other than a plan A, is the way to go.
I think every investor needs a plan. Everyone's plan is different, but I think you have to take the time to sit down with a competent investment professional, let them see what assets you have to work with, and more importantly, what you've been doing in the market. But I think a lot of times, Joyce, we overcomplicate the steps that are important in analyzing any market for investment, and I try to keep it down to just 4 simple things I'd like to share with your listeners. Number 1, I always look to pick a market. Number 2, I identify a major trend. Number 3, I choose a sector within the rising trend. And then fourthly and importantly, select the strongest stocks within that sector.
Great. And then from there, hopefully you've got a broad diversification so that you're not all in one sector of the market as well.
Very, very important.
Very important. I'd like to wrap up with something you mentioned at the very end of your newsletter in April on Straight Money Analysis, and it was talking about capitalism and yin and yang and brokerage firms, investment bankers, and Wall Street in regards to risk. And I thought it was brilliant, and I haven't heard it from anyone, and so I don't want it to come from my lips, but could you kind of paraphrase that for those that haven't read Straight Money Analysis, which would be a big mistake, but give them an idea of what you were referring to?
Well, I think when you talk about asset allocation and you look at where money is being placed in the economy, and I think, first of all, you've got to go back to the simple understanding that we've dismantled our manufacturing base, and it's been dismantled probably since the mid-1970s and early 1980s when we started to dismantle and certainly move jobs overseas. As you know, they first moved to the cheapest worldwide labor that we could find. What had happened initially, we moved jobs to Mexico, and then from Mexico they moved on to Southeast Asia. And we started to see banks and, more importantly, corporations not invest in manufacturing America, and money going into financial instruments and money being made by institutions by short-term trading and or the placing of debt. So I think we've seen a misallocation, a misappropriation of capital. I think it's still continuing, and at some point I think it will be reversed, and hopefully it will be reversed a lot sooner than people want to believe.
You talked about the consistency and a universal principle that kind of governs all things, and it's subject to the laws of nature that good cannot exist without bad.
Well, I think we've got to take a look at the values. I think we've got to take a look at what had once made America great, and I think we have to get back to the basics, and we have to get back to creating decent paying jobs in America so families within America can lead a decent life. And I think we've moved away from that. And I think we have to focus on manufacturing once again and putting people to work and have people buying American-made products.
Oh, amen to that. Buy American. That would be, if everybody did that, can you imagine what a stir we would cause worldwide?
Well, I know we're going to go back to that day. I don't know when that will happen. We may go through some more very painful and difficult times before that takes place. But I think if we can bring back manufacturing with the tax incentives and bring it back in a big way, and we can start seeing banks and institutions on balance lending money to build plants and modernize plants with new equipment, we certainly have a very talented and capable employment base, and we have an awful lot of good people with extraordinary talent that I think can make a difference if they're given a chance to re-enter the workforce.
I couldn't agree with you more. The American ingenuity and hard work is really a model of success that so many countries have emulated because they want what we have.
Well, I I think at some point it will happen. Hopefully it'll happen sooner than later. And I think when you take a look at what has happened just in Detroit with automotive, the jobs that we've lost there, certainly the devastation to the cities, and certainly the ongoing poverty that it's created. We used to make the best cars in the world, and I don't see any reason why we can't go back and do it again. I think we have to create the marketplace within